Welcome back to the Ultimate Trading Podcast for beginner traders. I'm Isabel Maria, and today we're going to immerse ourselves in a concept that, once understood, can become one of the most powerful tools in your trading toolkit: mean reversion. Now, mean reversion might sound a bit academic, maybe something only quants or statisticians obsess over, but the reality is that it's deeply practical. If you pay attention to the rhythms of the market, to how prices oscillate around averages, you can start seeing opportunities in places that many traders overlook. So what exactly is mean reversion? At its core, it's the principle that prices, over time, tend to return to their long-term average. Think of it like a stretched rubber band. The further it stretches, the more tension there is, and eventually, it snaps back. In trading, this snapback is where the opportunity lies. Extreme moves, up or down, rarely persist indefinitely. By identifying these deviations early, you position yourself to capture profits as the market corrects itself. Let me paint a picture for you. Imagine a tech stock, XYZ Corporation, which has been trending steadily upward for months. Then suddenly, earnings are released. The market overreacts, the stock surges far beyond what the fundamentals justify. Everyone is euphoric. Traders are buying aggressively. Maybe there's some FOMO, fear of missing out, pushing prices even higher. But as a mean reversion trader, your lens is different. You see that $150 spike on a stock whose historical average is around $100, with a typical deviation of $20. That's extreme. That's where you start paying attention. Let's break it down technically. First, the mean, or average, is your reference point. It's the price around which the asset tends to oscillate. Second, the deviation tells you how far the current price is from that average. Large deviations? That's where your radar goes up. Third, reversion is the process, the market correcting itself back toward that mean. This is not guaranteed, of course, but historically, it happens often enough to build a strategy around. Now some traders might say, but isn't the market random? Prices reflect all available information, so you can't predict them. And they're right, up to a point. Efficient market hypothesis and random walk theory suggest prices are largely unpredictable. But mean reversion is about human behavior. Markets overreact. Panic selling, euphoric buying, short-term herd behavior, these create temporary inefficiencies. Prices overshoot, then correct. That's where the edge lies. So how do you spot these opportunities? First, historical data analysis. Look at long-term price behavior to calculate the mean and standard deviation. This gives you a framework for normal versus extreme price movement. You want assets that naturally oscillate. High volatility instruments often revert more predictably than slow-moving ones. Next, technical indicators. Bollinger Bands, moving averages, RSI. Bollinger Bands, for instance, measure volatility and plot a price envelope around the moving average. When price breaks outside these bands, you're seeing an extreme. RSI helps confirm above 70 signals overbought, below 30 signals oversold. Remember, these are confirmation tools, not entry triggers on their own. And then, fundamentals. Ask yourself, is this price justified? Maybe earnings were stellar, but is $150 a reasonable reflection of intrinsic value, or is the market reacting emotionally? If the fundamentals don't support the extreme, mean reversion becomes compelling. Let's return to our XYZ Corporation example. 5-year mean, $100. Standard deviation, $20. Price jumps to $150. Bollinger Bands show the upper limit breached. RSI above 70. Fundamentals suggest overvaluation. You have the setup. Risk management now becomes your shield. You place a stop loss at $160, just in case the market keeps running. Position sizing? Maybe you risk only 1 to 2% of capital. This way, even if the trade moves against you, the loss is controlled. Now let's make this more immersive with a live trading style narrative. Imagine the first week after entering the short position. The market is volatile. Other traders see the hype and push the stock to $155. You feel a moment of tension. Do you close the trade? But your plan is clear: stop loss at $160. Exit at the mean. You hold. By the second week, the euphoria fades. Volume drops. The stock drifts to $140. You're starting to see mean reversion in action. By the end of the third month, the stock has returned to $100. Trade closed. Profit realized. But here's the nuance beginners often miss: timing is everything. Enter too early, and the trade might linger in drawdown. Enter too late, and most of the profit is gone. That's where psychology meets strategy. Mean reversion requires patience, discipline, and a willingness to stand against short-term market emotion. You're not trying to catch every wiggle, you're waiting for a statistically significant deviation. Let's layer in another element: volume analysis. When the price spikes to extremes, you want to see whether volume confirms the move. High volume during the peak can indicate strong conviction, which might prolong the deviation. Low volume? Often a sign that the extreme is unsustainable, increasing the likelihood of reversion. In XYZ's case, the initial surge was on extremely high volume, so the first few days were tense, but by watching daily volume trends, you start to gauge when the pullback is likely to accelerate. Now let's discuss adjustments mid-trade. Traders sometimes panic when price moves slightly against them. In our XYZ trade, imagine the stock briefly touches $145 after entry. A beginner might second-guess, maybe exit early. But if your stop-loss and position sizing are correct, this is simply part of market noise. You stick to the plan. And that's one of the most underrated aspects of mean reversion: trusting your analysis and risk parameters. Another layer: combining mean reversion with multiple timeframes. Look at daily, weekly, and intraday charts. The daily chart might show overextension, but intraday price action could give you clues on entry precision. For example, the stock might pull back intraday to $148 before resuming the extreme. Entering during that micro pullback can improve risk-reward. Let's also talk portfolio diversification. You don't want all your capital in one mean reversion trade. Apply the strategy across multiple assets that historically revert, balancing sectors and instruments. That way, one outlier doesn't derail your capital. Risk management isn't just about stop-loss, it's about exposure control across positions. And this brings us to journaling and reflection. Every trade, whether it hits your target or not, is a learning opportunity. Track entry, exit, deviation from mean, volume, market sentiment, and your emotional state. Over time, this journal becomes a feedback loop, refining your ability to spot and execute mean reversion opportunities. Before we close, I want to emphasize one last story. A commodity I trade regularly had spiked on temporary supply concerns. The RSI was screaming overbought, Bollinger Bands stretched, and the volume was unsustainable. Traders were euphoric, but fundamentals didn't support the high price. I shorted. It whipsawed slightly, but within weeks, the price reverted to the mean. That trade reinforced something crucial: mean reversion is not about predicting the market, it's about recognizing extremes and applying structured, disciplined strategy to capitalize on them. To summarize, mean reversion is about capitalizing on extremes, using a systematic approach to identify when the market has strayed far from its historical average. Tools, technical indicators, volume analysis, fundamentals. Edge, patience, disciplined risk management, and keen observation. Done correctly, it turns volatility, from something beginners often fear, into opportunity. So here's my question for you. Think about a recent market move that felt extreme. Did you recognize it as overextended? Did you act, wait, or hesitate? How did your psychology influence your decision? Share your experience in the comments. I'd love to hear how you're applying these concepts in real time. Remember, every extreme is an opportunity, but only if approached systematically, with risk control, patience, and reflection. That's the power of mean reversion.
Thank you for listening to the Ultimate Trading Podcast by Bells Forex AudioWorks. If you love this episode, hit follow, leave a quick rating, and share it with one trader friend. It really helps. Right now, head to bellsforex.com/tools. 6 professional-grade trading tools, 100% free, no sign-up. Use them on every trade. They're that good. Full guide is free at bellsforex.com or grab the Kindle version on Amazon. Until next episode, trade smart, stay disciplined, and keep building your edge. Happy trading!